Hey traders, this is Blake Morrow with Trader Summit, and with me today is Mr. Leo Nelissen. And it's been a while since we spoke. Actually, it was the end of last year we spoke. And you've advised some funds in the past. You write on Seeking Alpha. You talk a lot about global economics. So it's really nice to have you here, especially considering you've been in the camp that energy is going to keep inflation rather sticky. Do you still feel that way, Leo?
Yes, I mean, energy has been a bumpy ride. I think last week or 2 weeks ago we were at 85, now back at below 80. But in general, my thesis, actually since the end of the pandemic, has been higher for longer. And this applies to energy, inflation, and rates in general. And this is mainly based on changing supply and demand dynamics. I mean, most people know that before the pandemic, energy and specifically, oil and gas was a very tough spot to be, mainly because of the US shale revolution. Production growth was just astronomical, and this created a scenario where even smaller declines in demand caused steep declines in prices. It was just a very tough environment to be in. And this actually changed after the pandemic when most companies started to focus on free cash flow, which is based on multiple reasons, including the energy transition. And most companies knew, if we keep production high and if we crash the oil price again, there's probably not going to be anyone rescuing us, as everyone is currently moving to renewables. But in addition to these concerns, we actually saw that most of these shale producers were running out of tier one production in the Permian Basin or in other major production areas. They need to be careful with production. And that's another reason why these companies have somewhat reduced output growth. And what this achieved is it actually gave OPEC a lot of pricing power back, which they lost during the shale revolution. And as we see right now, they just keep extending production cuts and actually use this pricing power to their advantage, which is one of the reasons why oil is quite high in an environment where both China and the European Union are struggling economically. I always say, if this were like a normal situation for oil, like before the pandemic, we'll probably see an oil price of $15 low. And this isn't based on science, I mean, just an observation. I think that these supply dynamics have really created a scenario where it's going to be very hard for the Fed to pressure inflation back to 2%, especially if we get some kind of synchronized growth rebound at some point. That's why I always say, in this environment, I would say impossible to get $100 WTI, but when growth comes back and demand improves, I think we will see $100 oil. And then some producers will come back. OPEC will probably free up some of the cuts, bring back production. But in general, I think higher for longer in energy is here to stay. And even we even get support from somewhat unexpected areas like artificial intelligence. People are now figuring out how much natural gas we need to power these data centers, which is why most of these data centers are built on natural gas networks. And all of these companies, electric utilities are saying it, midstream companies, natural gas producers, they're all saying the same. We are seeing tremendous demand growth from artificial intelligence, and it's obviously not the main driver, but it's going to add
But it is
demand.
a driver. It is a driver,
Oh,
right?
absolutely.
So it's actually some little something small happened between the last time you and I spoke, and we saw an Israeli, Hamas conflict. That today, as you and I are speaking right now, they're trying to negotiate some sort of peace treaty. But how has that played into your thesis as far as energy goes?
I mean, politics are always tricky. I mean, I may listen to a few people I trust on the subject instead of figuring this stuff out myself. But what I have found in the past few weeks is, I mean, obviously the Middle East, they produce more than a third of global oil. So any escalation is bad news for oil. And when I say bad news for oil, it means higher oil prices. So bad news for the consumer. But we are not yet at the stage of full escalation. I mean, even when Iran bombed, at least fired these missiles at Iran, at Israel, it wasn't an escalation because Israel has phenomenal defense. And I think Iran knew this. I mean, Iran has tremendous problems with the quality of their missiles. I think 50% of ballistic missiles failed. In hypersonics, I would even, everyone talks about hypersonics, but they just don't have the quality that they need to actually do serious damage to Israel. And I think that's one of the reasons why Israel and Iran is just a stalemate, because Iran, I think, is just, they were just sending a message, right? If you, things have changed, if you attack us, we will attack you. And that scared markets a little bit. Oil prices increased, stocks came down a bit because people started to mention geopolitical issues in earnings calls. And we're obviously not out of the woods yet. I mean, I think Israel they have clear goals, and it will take a lot for them to actually retreat from Gaza. But I think these issues will be with us for a while and put some floor on the oil. But I don't expect this to result in a full-blown war, or as people say, the Third World War. I don't see it. And even the war in Ukraine has slowed. I mean, yesterday I read that Russia advanced at 2 kilometers. I don't know how many miles are that, 2 kilometers a week. Which, I mean, it's in the wrong direction, obviously, for Ukraine, but it's not the escalation that people feared. So I think from purely geopolitical point of view, that inflation risk, I mean, it doesn't help, but we probably won't see any major spike like we did in the 70s. So a risk, but not that big of a risk.
Yeah, understood. So our last conversation, we had a discussion about a lot of global economies may have a hard landing, and I think you excluded the U.S. from having a hard landing, so to speak. But you singled out other countries than some worse than others. Do you still feel that is the case? And do you think that central banks are going to be cutting, and are they going to cut rates aggressively? Where do you think we're at as far as, which countries are going to do better? Which countries are going to have more of a hard landing? And, are we even going to have a hard landing?
Yeah, I mean, that's probably the most important question everyone has on his mind. I think last time what I said is, I believe in a higher for longer scenario, inflation in rates. But I don't believe that we will see a scenario where the Fed is gradually cutting rates. And going into this year, the market expected 6 cuts. So essentially, the market was saying we are going back to normal. And when I say normal, I mean what we saw between the great financial crisis and the pandemic, where inflation was low, where central banks were actually trying to get inflation up to 2%. And tech stocks did well and all these things. But that has changed dramatically because most of these drivers of low inflation have completely changed, which includes energy, but also basic materials in general. Because of the energy transition, copper demand is up. Even China is weakening right now, and they're not consuming as much copper for construction, but now for next gen technologies, EVs, robotics, and just modernizing the economy. And then add geopolitical risks, supply chain reconfigurations. All of this is inflationary, and we didn't have these issues before the pandemic. So I always thought it was kind of nonsense to expect that without a good reason that we would just see these rate cuts to back to 2 to 3%. That's why I said, we will probably get closer to a scenario where central banks are forced to cut at some point, because if inflation stays high and growth comes down, you will get these, stagflation risks, and that could eventually lead, to the Fed breaking something, or the ECB. And the most recent stock market decline was actually based on some of these stagflation fears, because inflation has, for the past 4 months, inflation has come in higher than expected, with some upside momentum in recent reports. So that's bad. And now we get poor employment numbers. You see struggles in services, and even the middle class consumer is now starting to crack. I mean, since inflation became an issue, that weaker consumers running into troubles. Dollar General and all these companies noted it, and now we're seeing the same in the middle class, with Starbucks struggling, McDonald's. Even McDonald's, I think for the first time ever, they're saying that the consumer is weakening. And I mean, McDonald's is the go-to place for cheap food. At least it used to be that way. So we are seeing some underlying issues. And at this point, it's not that big of a problem. And I wouldn't say that that stagflation risks are extremely elevated right now, but the trend is going into the wrong direction, and central banks won't be able to help unless they see a path to, at least they have achieved low inflation. So my thesis has always been, we get to a point where, for example, the Fed has to pick between protecting the economy, which means credit quality. Like I see a lot of market reads that report very high charge-offs. Consumer credit defaults are going up. So that's an issue. So where the central banks just say, okay, we need to protect the economy and maybe let inflation run hard, or they say we need to fight inflation regardless of the cost. Obviously, the third option is a soft landing or even a no landing, but I don't think that's going to happen unless inflation comes down. So
Okay,
I'm
so
a bit bearish on that.
right, and so the Fed is going to be, and other central banks are going to be, trying to figure out, they're going to have to make some hard choices in your
Yes,
opinion.
I think so.
Okay. Let me go back. I'm gonna turn our attention, or maybe turn the attention to equity markets. We're just coming off earnings season. The bulk of US earnings have been reported already.
Yes.
What's your read on these companies? Because since the last time we spoke, the stock market has rallied to all-time highs, led the charge by a lot of US technology stocks. And I know you follow these stocks relatively closely. If you look at your Twitter profile, which is your first and last name, which everybody should be following you. What you've been mentioning a lot is about the Mag 7. So what has been your takeaway from this earnings season? Because in my opinion, they don't look bad, but there's probably more to it than just that. Is that right?
Yeah, I agree. I mean, it's not bad, but the same applies to the economy. I mean, the economy isn't bad, but when you look close, there's some areas that are bad. So what we have seen actually since mid last year is that the Magnificent Seven, who account, I don't even know how big their weighting is on top of my head, the biggest who are major drivers of the S&P 500. And these companies are all major beneficiaries of AI. And they all, just like after the pandemic, when all these major tech companies aggressively ordered, let's just call it tech supplies. And now we're seeing the same. Everyone is aggressively ordering all these hyperscalers, AI stuff for data centers, and that's actually where a lot of growth is coming from right now. If you look at other sectors like industrials, energy, basic materials, I mean, energy is even down compared to last year when prices were much higher. But in general, it's tricky. From what I'm reading and hearing, a lot of companies are seeing weakening demand. Railroads, for example, who have high intermodal/consumer exposure, they are seeing some bottoming, but the biggest declines were last year when inflation's increased. And if you compare earnings expectations, even for next quarter, the Magnificent Seven are seeing increases, and the S&P 493 is seeing declines. So this momentum is actually still strong, and there's this divergence between Mag 7 and non-Mag 7 stocks. So that's one of the things why I'm starting to focus more on value stocks, because if you look at the overall valuation going into this month, S&P 500 was valued at, I think, 21 times next year's earnings, and that's very lofty. Historically speaking, this implies 0 to 2% annual returns over the next 5 to 10 years, just purely based on historical data. So unless overall earnings growth remains high, we're actually looking at a scenario where a bigger part of our future returns will come from dividends instead of capital gains. And that would be the first time since, I believe, the post-dot-com crisis, dot-com bubble. So that's, well, generally speaking, look more for undervalued opportunities. And it's quite hard to find these in a market that's overall lofty valued. But that includes energy, obviously, but also, beaten down cyclical transportation stocks, stocks like John Deere, who come with inflation protection and also exposure to agricultural commodities. I like fertilizer stocks, as I've done for the past few years. So that's where I put most of my money in this market. with a long-term investment horizon over the next 5 to 10 years.
Leo, you said something rather interesting, where all the investment in AI, has been made, and that's where a lot of these earnings are working itself through all the companies. But will these companies be able to convert this AI into revenue? And how are they going to generate revenues from all this investment? That's going to be an interesting dynamic that we come across over the course of the next, I would say, 12 to 18 months. Wouldn't you agree with that?
Yes, I think in general, AI is obviously a fascinating topic, but it's so much demand has been pushed forward. That's one of the issues that I have. I mean, I liked Nvidia, actually bought it at 150, but I sold it way too early.
We always
But
do.
here's the thing with Nvidia. I mean, everyone says Nvidia is cheap on if you look at next year's earnings, and that may be true. But the problem is, and I think the same goes for many other stocks in that space, is that price to sales is very, very high. And the only reason why earnings growth is expected to remain so high is because of unusually high margins. And I said, the same happened after the pandemic. It wasn't AI, it was just different, semiconductors for different purposes, where just demand was pushed forward, margins were almost artificially high, and then demand normalized again, margins came down, and analysts adjusted expectations, and even stocks like Nvidia came down crashing. Now I'm not saying that's going to happen again. I'm just saying I really, really dislike the risk reward of these high-flying tech stock at these levels. I mean, stocks like Broadcom, Nvidia, they're just great companies, really terrific companies, but it's the demand. I mean, all these hyperscalers, Meta, Google, Amazon, they all have accelerated demand, and even companies like Equinox, which is a REIT in data centers, they even say demand is. I'm paraphrasing them a little bit, but demand is weakening, and they're seeing it. It's still strong, but its demand growth is weakening substantially. And I think that's one of these things that will, I think if you look in a few years, if you look back, people will say, yeah, it was obvious. But look, I don't have shorts, or anything against these companies, but I think that's a mistake to really bet on these companies, because we still need to figure out how strong AI is going to be. For now, it's just this big story. It could be, it's obviously one of the biggest things since probably the Industrial Revolution. Who knows? Since the invention of the internet, it probably makes more sense. But I don't know. I think it needs to be seen, but the demand is already here. It has been pushed forward, and it doesn't make for a great risk reward.
That makes sense to me. Leo, you're wonderful to talk to. I love the way that you think and you frame the markets. And you've given us a lot of ideas, especially maybe staying away from some of the high flying stuff and looking for more value based type of trades. Do you have any that I know you mentioned a couple companies, you mentioned Deere and a couple other companies that you really like. But anything else stand out as far as from an investment standpoint, things you like more than others at this moment?
Yeah, I mean, so I tweet this on Twitter as well, so it's nothing confidential, but I like Texas Pacific Land Corporation, TPL, which is a company that doesn't produce oil. They just own, the number is, they use hundreds of thousands of acres in the Permian Basin since 1888, long history, but they just own the land, and they have major producers like EOG, Chevron, ExxonMobil, who produce oil and gas on their land. So they make money on royalties. They make money on water sales because water is needed for the fracking process. They make money for midstream companies who build pipelines for takeaway capacity. They make money on solar. They make money on everything that happens on their land. So that's right now my favorite long-term play. And in addition to this, I really like Canadian National, Canadian Natural, which is, I also like Canadian National, that's a railroad. Canadian Natural is one of my biggest upstream positions. They produce oil in the Canadian sands with very low decline rates, more than 40 years of inventories. So they can actually grow production when American producers in some cases even reducing production. They have very low break evens in between $30 and $40 depending on the operations. I like midstream companies as well. Antero Midstream, AM is one of my favorites. And outside of this energy, I'm looking into growth and value hybrids for the longer term. Like I like Intercontinental Exchange, ICE, who own NICE. They have big operations in the mortgage industry where they have software where they essentially support the entire mortgage value chain from application to monitoring and all this stuff. So and that's a pretty big market that they're just at the beginning of exploiting this market, and they have strong pricing power. They make money on every transaction on ICE, and obviously John Deere, as I already said, they are struggling a little bit. Let's just say the economy, if you get a hard landing, they will suffer because it's a machinery producer. But in general, I'm very bullish on agriculture commodities, especially if energy prices remain high. And I like Nutrien and Mosaic to potash, phosphates producers, fertilizer producers, very, very cheap. And they are really tough to hold because they're very volatile. They usually only do well when inflation increases, inflation comes up. But those are two of my favorite plays as well.
Well, Leo, I want to say thank you for spending the time here on the Trader Summit. What's the best way for traders to follow your work specifically? I know they can find you on Twitter and they can find you at Seeking Alpha. Is that correct?
Yeah, usually. I mean, thank you. It's always a pleasure being on your show. I mean, it's Twitter is the most obvious way, and Seeking Alpha, that's where my public picks and public articles are. So that's the easiest way for people to and even also interact with me. Just send me a DM or whatever. I'm always open to interaction.
Awesome. Well, thank you so much for spending your time here on Trader Summit. And I won't reach out every 6 months. I'm going to try to get you on here, more frequently than that. I think people would really enjoy it. So thank you for your time,
Thank you.
Leo. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.